Well, there's been an interesting trend afoot in the recent months since really the October lows. You've seen some of the best, the worst performing sectors, I should say, be the best performing since then. Now, while tech has participated in some instances, other sectors like real estate have outperformed those ideas. So what's the strategy? What's the playbook into 2024? Should you switch into some of these laggers? Let's bring in Grant White, portfolio manager and investment advisor at IA Private Wealth. Grant, thanks so much for being with me. How are you thinking about that question right now, whether it's time to switch it up and wean yourself off of an addiction to the Magnificent Seven?
Yeah, it's a really interesting time. I mean, if you look back over the last couple of years, actually, if you look the comparison between value stocks and growth stocks, and in particular the Magnificent Seven, as you point out, they've actually come like right into lockstep with each other. But it's been quite a bit of a different ride looking at both of them. You know, going into last year, we were predicting that value stocks were going to continue to outperform coming out of 2022, but that lasted all of about 3 days basically before growth stocks started taking over again, which is what we've seen into the end of the year again. So, I'm quite confident, and we're feeling really good that as we look forward to a more broad-based market recovery, that more traditional value stocks are going to outperform again. Whether that's in 2024, I don't know, but I think there's a good chance of that.
And so, what is in that bucket of value stocks that you're doing your homework on?
Yeah, I mean, you could look at more traditional, like, especially like financials, and you could look at Canadian financials in particular, which have struggled a little bit this year. I think that we're going to see a little bit of return there, although I'm cautious about that because I don't think that we're seeing a 30% upside on bank stocks in Canada. I think you got to be a little bit more careful on that. But there is going to be, I think, a nice return there. We're also looking at companies like Magna, for example, and it's come through a lot of challenges over the last few years, whether it's the pandemic or, closing down plants in Russia. And, just recently over the last month, we've seen a nice report from them. And I think that their forward guidance is looking strong as well. And we believe that that's going to continue to look good. So we look at a company like Magna as well as there's good, strong potential for a bit of a resurgence there as well.
Let's back up to your point on the banks. The TSX Bank Index has underperformed the broad markets, but again, since those October lows, they're up as a group 17.5%. That's a pretty big move for a group like this. Do you think that it's close to tapping out, that most of the gains have been made and we go back to this kind of sideways trading? Or is that a signal, right, that we got this like pretty terrible set of quarterly results for most of the banks and investors are willing to look through that or take comfort in certain parts of it?
I think it's an interesting time because, bad news is almost good news as it comes to a lot of things that are going on out there. And then people are expecting the bad news. And so when they finally hear it, it almost relieves the pressure of the bad news coming. And so I do think that there's actually more upside in the Canadian banks, despite the recent gains, as you pointed out, Amber. But, I do think that also is dependent on a few things. I mean, everybody's watching interest rates right now. And it's pretty baked in. I think that, everybody's expecting interest rate drops next year of some degree. And, as we know, interest rates are incredibly difficult to predict. So we're going to have to see how that all plays out. But if we do go down that path, I do think that the banks still have a decent amount of upside to them as well. And I just think that you want to be measured in that. I don't think you want to expect that you're going to get a 30% upside, as I said earlier. I think that, you're going to get a more of a market rate return there, but you get the upside of the dividend at the same time, which is great.
You mentioned Magna, which if you catch it right, you can make a lot of money in the near term. But over, the last year and a half, call it almost 2 years, it's really just been trading sideways after pulling back pretty significantly after the pandemic. Yeah. What gets it re-rated? What gets you excited about a Magna?
I think like Magna's, it's because it's come through so much negative news and negative things that have gone on, really. I think that actually it's almost to the point where it's like anything good news is going to look good for this company. And they faced a lot of headwinds going into the last quarter. And we're still able to, despite those headwinds, we're able to perform really well. So I think that they've overcome a lot of the, production challenges and logistics challenges that they've faced over the last few years. And I think as they've come through that, there's an opportunity there. And the fact of the matter is, I still think the market is pricing them in for all those challenges and really underestimating what they can do going forward. So I think the market's underestimating them, giving us a good value opportunity there. And at the same time, I think management's got a good handle on it now.
One of the worst performing sectors, I'm curious your view, given your value lens, had been real estate. But since those October lows on both sides of the border, best performing. Are you picking away at names in that category?
Yeah, well, we still really like Brookfield in particular. I like playing Brookfield just because it's such a broad-based company. So we get a lot of diversity in this company. And with alternative assets being like a bit of a hot button over the last few years, and especially this year coming out of last year's markets, I think Brookfield is a fantastic way to play an alternative asset class, which is going to continue to be in client portfolios, I think, long into the future, if not forever into the future. One of the reasons we like Brookfield so much is because really they're the class act in the alternative space. I mean, if you're looking to raise, if you're a sovereign wealth fund or if you're a big pension plan and you're looking to raise some funds and put it towards, alternative assets, I think Brookfield is a player that's always in the mix as it relates to those, just because they have the size and scale really matters in the space. So, from that perspective, we're chipping away at that. The other reason I like Brookfield is even if we have concerns about, real estate, for example, especially if you look at office real estate, Brookfield owns some of the best properties in the world, and they tend to own the best assets in one particular city. And that gives them a lot of pricing power. And so we're less concerned about properties that a Brookfield would own versus many other real estate funds, if you will. So that's the way we're chipping at it. We're measured in it, but we are chipping away at real estate as well through them.
All right, interesting.